All right, question number 2 from the paper. We'll break this up and we'll do these as because they're all independent and they're not related, so each of these questions is independent of each other. So let's deal with question 2A first. It says a motor car manufacturer is being sued by a rival for infringement of patent rights. A court case has been commenced, but a decision is not expected until after the end of the reporting period. So that's a bit of information I need to digest. Lawyers representing the business are unsure if the court will find in favour of the business and the extent of the liability for an unfavourable ruling. Does the motor car manufacturer need to record a liability for the lawsuit? Give your reasons. Now, this takes into consideration the definition of a liability. So, now liability is a current obligation. It's risen from a past event, means an outflow of future economic benefit. It's probable that event is going to give rise to an outflow and that we can measure the outflow of that reliably. So taking into consideration that, does this car manufacturer have a current obligation? Well, the lawyers are unsure if the court will find in favour or against the business. So if we're unsure, we don't have a current obligation. So therefore, do we need to record a liability? No. But full disclosure principle says that we need to disclose to the investors any information that could be material to the business. So no, I don't have to disclose a liability. But I need to disclose contingent liability. As the court case could be unfavourable. There you go. Easy peasy lemon squeezy. All right, let's have a look at B. On the 1st of January 2018, Chet borrowed $80,000 from Upway Bank by signing a 6-month, 12% interest-bearing note. Okay, it says, prepare the journal entries for Chet Limited to record the issue of the note, the balance day adjustments, to record the accrual of interest for the year ended 30th of June, assume no other interest accruals have been made, and payment of that note on maturity. Okay. So let us go. What's the 1st of January? So 1st of January is the date, so we've got here B. So I've got my description and I've got my debit column and my credit column. Okay, so the first thing I'm going to record is I'm going to record the borrowing of the $80,000. So that first thing first is affects my cash account for $80,000. Our cash account normal balance is debit. And I'm going to create a liability called note payable of $80,000. And that's the end of that first journal entry. So I've recorded the issue of the note. Now the balance day adjustments is the accrual of interest that we're looking for. Now my calculation would be, 12%? So 12% times 80,000, 12 eighths, 72. Okay, so 12 8 72, and what's that? That's 3,600. No, hang on, 12 eighths is more than that. It's 96, isn't it? Divide that by 2 equals 4,800. Is my interest for the 6 months. So that's my interest I've just calculated there. So if I'm going to do my interest, I have an interest expense of 4,800 and I have interest payable, which is my liability of 4,800. And that takes care of that balance day adjustment. And then the last thing is the payment on the note of maturity. Now the note is from the 1st of January and it's 6 months, so it'll mature on the 1st of July. So hang on, so that's the 30th of June here. This is the 1st of the 1st. And my last entry goes in on the 1st of the 7th, which is my maturity date. And I have my note payable of 80,000, which is just the reverse of this entry up here. I have my interest payable of 4,800, and then I have a cash balance of 84,800. And that's parts A and B.